Ghana is Africa's largest gold producer. In 2023 alone, the country produced over 4 million ounces of gold, worth more than $8 billion at the global price. Gold leaves Ghana every single day, shipped, refined, traded, and stored across the world. Despite all that gold, Ghana still struggles to pay debt, stabilize its currency, and fund basic development in the country. In so many towns, clean water is scarce. In others, farmland has been destroyed.
BDM, come and save us. We don't have water. BDM, come and save us. We don't have water.
And many young people living right next to the gold mines have never seen real wealth from them. This is not just a Ghana problem. Across Africa, countries rich in minerals remain poor in outcome. Ghana's case is especially revealing because Ghana is often being described as a success story because of their stable democracy, strong institutions, and decades of gold mining experience. So, if Ghana is still losing out, it means something deeper is going on that they are not telling us in the media. If Ghana produces so much gold, why does the country earn so little from it? Who actually makes the most money from the Ghana gold? And where does that wealth end up? That is the question a lot of people have been asking. And is the problem corruption, bad contract, or a global system designed to work this way? Ghana gold stories sound very impressive on paper. In 2023, Ghana produced over 4 million ounces worth roughly $4 billion. That makes Ghana the largest gold producer in the whole of Africa, ahead of even South Africa. The mines are massive, modern, and often run by multinational companies. On papers, Ghana should be rolling in wealth, but the reality is very different. Despite this gold production, Ghana revenue from gold is far smaller than you might expect. Mining royalties, taxes, and dividends combined bring in less than 10% of Ghana's national revenue. Meanwhile, Ghana continues to borrow heavily from international markets, struggling with a debt-to-GDP ratio that hovers around 90%. Gold is leaving the country every day, but the benefits for ordinary Ghanaians are limited. Why does this happen? This is the question a lot of people, including myself, have been asking. Part of the answer is how mining contracts are structured. Most large mines in Ghana are operated by foreign companies from Canada, Australia, and China. They invest capital, yes, but agreements often favor them in terms of profit repatriation. That means much of the revenue from gold sales is sent abroad instead of being invested locally in Ghana. For example, even a mine producing hundreds of millions of dollars in profit may only return a fraction of that profit to the government after tax incentive, royalties, and deductions. Around mining towns like Obuasi and Takwa, residents often struggle with poor infrastructure, water shortages, and environmental degradation due to gold mining activities. Not only that, farms are destroyed by mining operation, and small-scale miners risk their life in unsafe conditions for tiny profits. Gold is literally under their feet, but the wealth flows abroad. Compare this to countries like Australia or Canada. Gold miners in this country pay higher taxes and royalties, contributing to national budgets that fund health, education, and infrastructure in these countries. Citizens see a tangible return on the natural resources beneath their land. Ghana has yet to reach that level of local benefits, and so many other African countries too are in this level. Even the IMF and World Bank reports highlight the paradox. Ghana is rich in gold, yet human development indicators in mining areas remain below the national average. What is the problem with Africa? Roads, schools, and hospitals are often lacking. Mining contributes to GDP. Yes, we know that. But GDP doesn't measure who actually benefits from it. This gap matters a whole lot because it shapes politics, economics, and social trust. Young Ghanaians hear about the billions of dollars exported in gold and wonder why their salaries are low, why basic services are weak, why opportunities are scarce in their country.
By May alone, the GoldBod had exported 11 tons of gold valued at USD 1.1 billion. Actually, it's in May alone.
Gold is supposed to be a blessing, but for many Ghanaians, it feels like a silent cost to them. This isn't just about bad governance. It is about global rules, contract designs, and power imbalances that favor investors over citizens. Understanding this layer helps explain why Ghana produces so much yet sees so little from it. When you think of Ghana gold, you might think of ordinary citizens becoming wealthy or towns thriving around mines. The truth is, most of the big money never stays in Ghana. Take multinational mining companies, for instance. Firms like Newmont's, Anglo Gold Ashanti, and Goldfield operate major mines in Ghana. They pay upfront investments, employ staffs, and build infrastructure, but they also export their profits abroad. Their earnings go back to headquarters abroad, stakeholders, and investors who also base abroad. The Ghanaian government collects royalties, but these are often fixed percentages, sometimes lowered through tax holidays or special agreements. That leaves a large portion of profit outside the country. Even the banks and traders who handle gold globally benefits more than Ghana. London, Zurich, Dubai, these are hubs where raw gold is refined, traded, and sold at premium price. Ghana sell raw gold at the market rate, but the refining and higher value transaction happens elsewhere. Once again, the major gains are realized abroad and not in Ghana. The situation is worse for small-scale miners. Galamsey miners work under dangerous conditions. I don't know if I pronounced that well. Often illegally, risking environmental damages, police actions, and personal safety. They make a tiny fraction of what the gold they mine is worth. Sometimes, they are forced to sell to middlemen as far below market value. They supply the gold, but rarely see the wealth it generates. This pattern is not unique to Ghana alone. Across Africa, countries rich in resources face the same reality. For example, the Democratic Republic of Congo produces over 70% of the world cobalt, yet most wealth from this cobalt flows to multinational corporations and foreign refiners. Angola export oil but import fuel at higher prices. Nigeria export crude but struggles with local energy supply. One key difference in Ghana is that the country is politically stable and well documented. The deals are transparent enough that analysts can trace exactly how much revenue goes where. That makes the corruption more easier to see and the frustration among citizens more visible. So who wins? The winners are shareholders in New York or Toronto, global banks, commodity traders, and sometimes the local political elite with stakes in contracts. While the losers are local communities, small miners, and ordinary Ghanaians who should benefit from their country's natural wealth. The takeaway here is clear. Ownership and value addition matters more than production alone. Ghana could produce 10 million ounces of gold a year, but without fair contracts, local refinement, or higher royalties, the country remains a supplier, not a beneficiary from their own gold. Later in this video, we will explore ways Ghana and Africa could capture more value from their resources. But first, let's understand the global system that allows wealth to leave Africa so easily. The reason Ghana struggles to benefit from its own gold isn't just local contracts. It's also the global system of trade and finance. Gold is a globally traded commodity priced in dollars. That means Ghana earns in foreign currency but spends in local cedis. When the cedis falls, gold revenues are worth less at home. Inflation rises, fuel becomes expensive, and citizens feel the pinch even as billions leave the country. Then there is the refining process. Most of Ghana gold is exported in raw form. Refining, smelting, and value additions happens in Switzerland, Dubai, Canada, and many other foreign countries. But Ghana misses out. If Ghana exported refined gold, it could earn far more ounce and create local jobs in processing, technology, and export management. Loans and debt also tie Ghana hands. Part of gold revenue goes directly to debt repayments. In 2023, Ghana spent billions of dollars servicing Eurobonds and other international loans. So even when gold prices are high, much of that money never circulates in the local economy. Compare this to Australia. The country mines gold, refines it domestically, sells to local and international market, and taxes it heavily. Citizens see infrastructure, schools, and health system funded by mining. Australia has strong regulations, higher royalties, and local beneficiation. Ghana has none of this advantage at the same scale. Then there is environmental and social cost. Mining displaces communities, pollute water, and damage farmland. The people who bear this cost often see little compensation, while profit leaves the country in billions of dollars. The combination is stark. Ghana produces gold, pays the environmental and social price, service debt, yet gains less than it should. Foreign companies, banks, and market benefit the most. This dynamic shapes African geopolitics. Wealth extraction without local benefit fuels inequality, migration, and political tension. Countries with rich minerals can become trapped in cycles where they remain resource exporters, not wealth creators. And this is the case of Ghana and many African countries. Later in this video, we will also explore how Ghana could reclaim control over its gold industry and captures more value. For now, it is clear production alone is not enough. Without fair contract, local processing, and strong economic strategy, gold makes everyone rich except country it comes from. When we talk about Ghana gold, most people think only about the huge export numbers. But the real question is, how much of that wealth actually stays in Ghana? The story is more complicated than headlines suggest. Let's start with the good news. In 2024, Ghana mining sector delivered a record 70.7 billion Ghana cedi in revenue to the government. That revenue came from corporate taxes, royalties, dividends, and other fiscal contributions from gold. Royalty payment alone jumped nearly 77% from 2.8 billion Ghana cedis in 2023 to 4.9 billion Ghana cedis in 2024. That means Ghana is collecting more money from gold companies than before. And the trend continued into 2025. Throughout the first 9 months of the year 2025, large-scale gold mining royalties reached about $291 million, which was 40% increase compared to the same period in 2024. This is real progress. More revenue flowing into state coffers that can be used for schools, roads, vet clinic, even support for communities. So why does this revenue story often still feel disappointing to ordinary Ghanaians? Part of the answer lies in how revenue is earned and spent. Royalties are based on gross sales, not profit, and taxes are calculated under long-standing fiscal rules that were negotiated years ago when gold prices were lower. Ghana has recently begun updating these fiscal policies to capture more value from gold in times when global prices are high. The government is also introducing reform to make the system fairer. New policies are being introduced. These policies are aimed at scraping old stability agreements that locked mining companies into low royalty rates and to raise baseline royalty rates so that Ghana can benefit more when prices are high. Another part of the story is smuggling and informal trade. For years, a large share of gold left Ghana illegally, meaning the state never got taxes or royalties on that gold. That is one of the reasons Ghana created the Ghana GoldBod in 2025. GoldBod becomes the sole authorized buyers and exporter of licensed gold. This is designed to stop smuggling and make sure revenue go into official channel. These reforms are very important. They show that Ghana is not passive or locked into hopeless contracts forever. Instead, the country is actively trying to capture more of the value chain from production to selling gold legally and traceably. But the process takes time. It requires stronger institutions, better enforcement, and a clear strategy to ensure revenue reaches communities quickly and transparently. Ghana Gold is bringing in billions more than before, but the country is still learning how to convert that influx into widespread prosperity. The reforms, of course, are a step in the right direction. One of the most striking parts of Ghana Gold story is the contrast between big numbers and everyday life. On the one hand, Ghana gold mining contributes billions of cities to government revenue. On the other hand, many ordinary communities near mining areas still feel left behind. Gold production in Ghana is not small at all. In 2024, the country mined an estimated 4.9 million ounces of gold. That is roughly 136 metric tons, an 8.5% increase compared to the year before. That output helped Ghana stay at the top of Africa gold list, but big gold numbers don't always translate into local jobs or thriving farms. In many mining towns, the opposite is true. Residents often talk about polluted water, damaged farmland, and limited infrastructure. Illegal mining is a big part of this problem. Pits appear in forest and farmland, often without regard for water sources or soil health. As a result, medicinal plants that communities rely on and even cocoa farms are disappearing. Some reports indicate that 70% of Ghanaians depend on traditional medicinal plants that are threatened by illegal mining activities. This illegal mining also contributes a significant share of gold production. Artisanal and small-scale miners are estimated to produce billions of dollars worth of gold, sometimes accounting for over 35% of total output in the country. That is a huge figure. These small miners often work without formal safety protection and sell their gold in the formal market where prices are lower and revenue to the state is often limited. This means a lot of value leave the country in ways that don't benefit the government or the communities. These are the reasons Ghana created the Ghana GoldBod to better track and control gold purchases, reduce smuggling, and ensure more revenue enters official channels. Compare this to countries that export refined gold instead of raw gold. In those places, beneficiation, the process of adding value locally through refining or manufacturing, can create jobs and keep more of the profit within the country. Ghana is beginning to push towards that model, but it is still in the early stages. Meanwhile, many local people who live near the both legal and illegal mining don't see enough of the wealth from this gold. When the same companies make big profit and people nearby struggle with bad roads, polluted rivers, or broken wells, it is easy to see why many people ask, who really benefits from our gold? Yes, the government gets revenue. Yes, reforms are improving fiscal flow, but a lot of the actual value still happens outside Ghana. Until more of that part of the value chain happens inside the country, many ordinary Ghanaians will still feel the wealth slip through their hands. One of the biggest reasons Ghana doesn't get as rich from gold as it should is very simple. Most gold leave the country in raw form. Raw gold sells for a lot of money, sure, but it sells for far more money after refining and processing. When it is refined, minted into products like jewelries or bars, or turned into industrial components, it generates additional profit. That profit is where the real value lies. Right now, Ghana exports huge amounts of raw gold. In 2024, exports reached $11.6 billion, a 52% jump from the previous year. Those are big numbers, but imagine if some of that gold were refined inside Ghana instead of just selling it to foreign refiners. Ghana could earn extra value per ounce. This is why countries like South Africa and Australia have big refining industries. They mine gold, but they also refine it domestically and sell finished product domestically as well. That means more jobs for engineers, technicians, factory workers, and more tax revenue flowing into national budgets. Although Ghana has started making small steps, the creation of the Ghana GoldBod is one of such steps. GoldBod aims to centralize gold buying, reduce smuggling, and ultimately create a more structured gold value chain that could include refining. There is also talk of building ISO-certified gold laboratories and manufacturing hubs. These are not just places to test gold purity, they are technical foundations for a local refining industry. If Ghana can move part of its gold industry from raw exports to processing and manufacturing, it will capture deeper value that usually end up in foreign markets. Look at the difference with oil-producing countries that refine their own petroleum products. These countries often retain more wealth locally because refining creates industries, jobs, and secondary businesses. Right now, Ghana exports raw gold but imports many of the goods it needs, including refinery services and luxury items. This trade imbalance means gold earnings are often spent abroad rather than boosting local production. Value addition also strengthens resilience. Global gold prices can swing dramatically. When Ghana relies only on raw exports, the economy becomes very sensitive to price changes. But if Ghana has domestic industry that use gold, not just export it to raw, then the economy can absorb shocks better, even when gold prices fall in the international market. This is why many analysts argue that raw production figures are only half the story. A miner punching out millions of ounces is an achievement, but the real win comes when that gold is transformed inside Ghana. Value addition isn't just technical jargon. It is the difference between making wealth leave your country and making wealth grows inside your country. Over the years, Ghana has learned a key lesson. Production alone isn't enough to build lasting wealth. Gold production numbers make headlines, exports fill balance sheet, but if the next stages, which are refining, value addition, job creation, doesn't happen locally, the country remains a raw material supplier, not a wealth creator. Right now, Ghana shows a sign of change. One major development is the rise in gold royalties and fiscal reforms intended to increase government revenue from mining. Royalty receipts in 2025 rose sharply as mining companies complied with regulatory requirements, bringing more cash into national coffers. Also, the Ghana GoldBod has been introduced as part of a broader strategy to control gold trading, reduce smuggling, and build value chain capacity. This is important not just symbolically but practically. By requiring that gold passes through a central body, Ghana can track tax and eventually refine more of its production domestically. But reforms need to go further. First, infrastructure investment is essential. Refining facilities, assay labs, and manufacturing hubs must be built and maintained. These facilities don't just appear. They require capital, technology partnership, and long-term planning. Countries like Ethiopia and Morocco have used public-private partnership to establish refining capacity. Ghana can explore similar models that combine government backing with private investment. Second, education and workforce training are very critical. Skilled refinery technicians, metallurgists, and engineers are needed to operate advanced facilities. Investment in vocal training and partnership with universities can build that workforce. This not only creates jobs, but also retain talent that might otherwise migrate. Thirdly, government policy must support local businesses and small-scale miners, not just large companies. So if we are to do this, we must understand not just that company. Artisanal miners currently contribute a significant portion of gold output, but many operate informally and lose out on fair pricing. Strengthening the legal framework, offering better access to markets through GoldBod, and supporting cooperative models could give more income in communities. Fourth, environmental protection and land reclamation must be part of any growth strategies. Illegal mining practices degrade land, pollute rivers, and undermine farming, which are the very sector that sustain rural livelihood. Effective regulation and enforcement, balanced with viable economic alternative for local youths, are non-negotiable. Lastly, Ghana should continue to pursue regional and international partnerships that expand market access without sacrificing value. Africa Continental Free Trade Area Framework will help Ghana gold-related industries find buyers and partners across the continent of Africa, and cooperation with ethical refiners abroad can build capacity while protecting standards. The truth is simple. Ghana gold can be a true engine of prosperity, not just a source of export dollar, if value is added before it leaves the country. If Ghana really wants to turn gold into lasting wealth, it needs to look at how other countries handle their resources. Africa and the world are full of examples, some successful, some cautionary. Take South Africa, for example. South Africa produces more gold than almost any other country in history, but decades of exporting raw gold left the country very vulnerable. Communities started seeing wider economic benefit when the government combined mining with domestic refining and local beneficiation. Skills jobs were created, manufacturing grew, and more revenue stayed inside the country. Ghana is in a position to learn from this pattern. Outside Africa, Australia offers another example. The country has huge gold deposits, but it has invested heavily in refining, technology, and workforce training. Australian miners export gold products rather than just raw ore, and the government collects taxes that fund infrastructure, healthcare, and education in the country. The key difference is Australia keeps a larger share of the value inside the country. Even smaller countries like Peru has developed industrial clusters around mining, local processing plants, smelting facilities, and partnership with universities create jobs and reduce reliance on foreign exporters. This demonstrates that size doesn't automatically determine success. What matters is policy and strategic planning. Ghana has begun taking some steps in this direction. The creation of the Ghana Gold Board is designed to centralize gold purchases, curb smuggling, and eventually support local refining in the country. Plans for ISO-certified asset laboratories and partnership with global firms indicate a move towards value addition, but this initiative are still very early. Without speed and scale, Ghana risks repeating old pattern, which is producing large quantities of gold but losing most of the benefits to the global markets. Finally, global partnership matters a whole lot. Ethical trading relationships, regional market access via AfCFTA, and foreign investment tied to local processing can multiply benefits without sacrificing sovereignty. The key is for Ghana to move beyond being a raw material exporter towards controlling its own value chain. Learning from this example shows that wealth is not automatically tied to how much goods you produce. It depends on policy choices, infrastructure, and strategic planning. Ghana has the resources, the knowledge, and the institutional capacity. The challenge is turning potential into real inclusive wealth. So far, we've talked about numbers, royalties, and contract, but what about people, the everyday Ghanaian living near gold mines or trying to benefit from the industry. In many mining towns, the story is complicated. While Ghana exported over 4 million ounces of gold in 2024, residents in areas like Takwa, Obuasi, and Ahafo often struggle with the basic infrastructure. Apology to Ghanaians, I don't know if I pronounce those names very well. Roads are damaged by mining trucks, water sources are polluted, and schools are underfunded. Mining revenue brings national wealth, but it doesn't automatically trickle down to the local communities. There seems to be light at the end of the tunnel. Ghana government is trying to formalize artisanal mining through licensing, training programs, and market access via GoldBod. Small miners could earn more, work safely, and contribute to the national economy legally. This will keep more wealth inside Ghana and improve living conditions in mining communities. Comparing to other countries helps illustrate the gap. In Peru, for example, artisanal gold miners are integrated into the formal economy. They work through cooperatives, access fair market, and receive technical training from the governments. This model increases earnings, reduces environmental damage, and creates local prosperity. Ghana could adapt similar system. The broader message is that gold can improve lives, but it requires deliberate action on the part of Ghana government. Production alone is not enough. Policy, enforcement, and local addition and community investment determine whether wealth truly benefits ordinary people or leaves them behind. Gold shapes Ghana economy at the national level and daily life at the local level. Understanding this dual impact is critical for anyone who wants to grasp why Ghana gold story is both powerful and frustrating at the same time.